is Ermias Shatu, the CEO of FSD Ethiopia. Nothing that you do not know. We've already been around, primarily working on financial markets deepening, making the financial market more efficient, more resilient, more sustainable. Our ultimate aspiration is to really support the hard-working actors of the financial markets, supporting the capital market team where we can, all the hard-working team of the Capital Markets Authority, the Ethiopian Security Exchange team, the National Bank, the Ministry of Finance, just trying to support the realization of an efficient financial market in Ethiopia.
Thank you so much for coming to this knowledge series focusing on investment banking. Really appreciate FSD Africa for their continued support in terms of providing us this type of platforms to exchange knowledge, to invite distinguished guests like Craig and Paul to provide us an exciting opportunity to have a conversation, and of course also to provide you the background in terms of what we are doing. The Capital Market Authority continues to work with FSD to make sure that we deliver on our commitment in launching the exchange next year. So, yeah, we'll definitely do that. So, in terms of today's knowledge series, the role of investment banks in a capital market ecosystem is fundamental. They take the lion's share of preparing companies for public offering, listing, and guiding them to successfully navigate the various regulatory requirements. Most of them that's going to be put in place, or some of it already put in place by the Ethiopian Capital Market Authority. Moreover, the interface between companies who wish to be listed and investors that are at early stages of the process, were at times putting their capital at a high or to moderate risk, and as such, the authority recognizes this important role, and then we're ready to provide potential market participants who wish to acquire an investment banking license all the support that they need. The Capital Market Authority is completing the regulatory structure, as you know, to be able to issue the investment bank license. We have concluded a series of public consultation regarding the licensing requirements. We are getting ready to issue the investment banking license and other capital market service providers license to both domestic and international market participants. And just to give you very few highlights in terms of what is expected, what we're expecting from potential applicants to acquire a capital market service provider license, and specifically an investment license. In terms of corporate structure, as I'm sure you've seen on our draft directives, the company structure could be a share company or a private limited company. Investment banks cannot be deposit-taking financial institutions. This is one of the things that we're working with the National Bank of Ethiopia to make sure that there is a Chinese wall between the deposit-taking banks and any subsidiary that will end up being established and providing the different types of services. So the National Bank of Ethiopia is already working on the necessary adjustment to permit our private banks, our insurance companies to be able to provide many of the services that we have introduced in our directives. In addition to the investment banking structure, they could also act as a broker or financial advisor for institutional clients, facilitate the issuance of securities by companies, governments, and other entities through various forms of underwriting. And in terms of capital requirements, we have we've structured it in two different ways. As you've seen it on our directive, the minimum capital requirement for investment banks within a banking group. For example, if there is a retail banking affiliate that is establishing its own subsidiary, then the capital requirement that we put in place after an exhaustive consultation, as I'm sure you know, is $100 million, 100 million birr, beg your pardon, and a minimum capital requirement for an investment bank, not part of a banking group, is 25 million birr. This is something obviously could be triggered in terms of operating as non-deposit taking financial institution, being able to operate in this sphere only once the National Bank has determined as to the final structure. So, but we are finalizing the work that we need to do as the Capital Market Authority to provide the first investment banking license in Ethiopia. And I hope that most of you out here who are working in the insurance sphere and the banking sector are getting yourself ready. Having said that, of course, there will be a lot of conversation about investment bank, but let me at least give you a couple of updates in terms of the Capital Market Authority, where we stand right now. As you know, we've announced an agreement with the Chartered Institute for Securities and Investment to provide consecutive training. The market ecosystem requires experts, and you know the sector itself have a very nuanced expertise that it requires. We're partnering with CISI to provide significant amount of training, some of it with our own expenditure, some of it obviously others could take by themselves. But tomorrow we also would announce a major initiative with Addis Ababa University Commerce College, where CISI has given the accreditation to Addis Ababa University College of Commerce to be an accredited institution to provide this training. For commerce, as I'm sure you guys know, it's one of the most important institutions in Ethiopia that provided accountancy, marketing, and several finance-related training to be recognized by CISI and to be able to provide this accreditation. By the way, not only in Ethiopia, but also in the region. It's a critical milestone for us, and we're very much excited tomorrow to launch that. And we encourage folks who wanted to take any type of training to obviously approach them and work with them. In addition to that, we're working with one of the most important financial institutions that are focused in the business reporting journalism aspect of it. I won't be able to say who they are right now, but we're finalizing the agreement. We'll make that announcement to train journalists and to make sure that financial reporting is done in a most professional way, because ultimately investors would rely on the journalists will go through, dig through the tons of corporate action, the tons of reports that will be published, and the journalists will be doing a significant amount of the work. So we're working in that regard as well, so that there will be a scholarship for around 50 journalists, and they will be trained to study, to report in part of our entire ecosystem. So that's also on the pipeline. That's something that we'll announce very soon. And finally, there will be a new directive that we are finalizing, that will be issuing, which is a very important directive in my view. It's a public offer directive that will be regulating this wild west type of scenario that we currently have. Everybody gets up and issues a share and says that you can make a ton of money if you buy this company's share without any due diligence, without any type of going through any regulatory process. We'll be announcing that directive that will be coming out very soon. So just to conclude, really wanted to thank FSD again, all of you for coming here today, and the invited guests this morning that will provide us an overview of an investment bank. It's a beast investment bank. Obviously, with 4 or 5 hours, we're now going to cover every topic of investment bank, but at least I hope that this session, this knowledge series, would give you the snippet, the idea of how important it is in this ecosystem. The Capital Market Authority will continue to work with you. Anybody who's interested in this sphere, come to us, talk to us. My entire team from Capital Market Authority is here. We can have a conversation later on if there are any institutions who are interested to pursue acquiring this license, because we're finalizing from our end. I thank you for listening, and I wish for a very successful consultation on this. Thank you.
If we look back, investment banking in the US, it was defined by two major events, that of the 1929 Great Depression and the 2007 global financial crisis. What we're doing is to learn from that. Dr. Brooks' note on that respect is quite helpful, and regulation eventually becomes the responsibility of everyone, not just the Capital Markets Authority. So the history of investment banking goes back to the 17th century, 1602, the Dutch East Indian Company. Presumably there were some group of people that put together the investment for that company. And then of course, we hear a lot more of investment banking in the late 19th century, about like 1890s in the US. But prior to that, in the UK, there were also what we call merchant banks. Those are the ones that were trading with silk, spices, and metals. And they evolved into merchant banks. And eventually, they evolved into what we call investment banks. Everyone had their own humble beginnings. And we believe this is also our own humble beginnings. We're going to make mistakes, we're going to learn from them, and we're going to make it stronger. We're going to make sure that our capital markets and investment banking mobilizes risk capital to businesses.
Let me just introduce myself very briefly. I actually do have a page with my background, but I will introduce myself very briefly. Hermes bigged me up so much that I can only disappoint at this stage. I was an investment banker for 25 years, the last 17 at Merrill Lynch, which after the financial crisis was taken over by Bank of America, so Bank of America, Merrill Lynch. I held various senior positions at Bank of America, Merrill Lynch, including global head of equity capital markets. I was vice chairman of global capital markets. I also was co-head of our capital markets business in Asia Pacific. So I've spent most of my career in London, although I did spend a few years as well in Hong Kong. I was responsible, though, for global businesses, and that includes the US, and I've worked on transactions really on every continent except maybe Antarctica. The other observation I would make is I started out as a lawyer, so I'm very interested in a lot of the commentary about regulation. I was a lawyer at Sullivan & Cromwell. I should mention that, I went to Harvard Law School and I graduated in 1992. And in the class ahead of me, the class of 1991, I had two incredibly distinguished people who were, students, fellow students. One of them was Barack Obama, who, as you all know, became the 44th president of the United States. And the other very distinguished person who was a year ahead of me at law school is here in the audience today. It's my friend Rebecca, going back 30 years. I've known Rebecca for 30 years. She's the founder and executive director of the Haley Manass Academy, which I visited yesterday in Deborah Birhan, and it was an incredible visit. And if you're not familiar with what they do, It's a well worth your while. The Haley Maness Academy was an incredibly moving visit for me. So that's my background a little bit. I don't have any slides, but it's not a problem. I will continue to discuss it. One thing you learn in investment banking is you learn how to improvise. Markets can be very volatile, and you actually learn and you have to adapt. As Ermias said, since I retired a year ago, I have been doing a few other projects, including I've been writing on a freelance basis for the Financial Times in the Alphaville section. And if you look in today's Financial Times in the Alphaville section, if you go online, you'll see I wrote a column about the 20th anniversary of the separation of investment banking from equity research. I will explain what that is in a moment, but it was actually a very key milestone for investment banking and actually for the regulation around investment banking. Okay. Look, investment banking is all about financial intermediation. It's all about being in the center of things. And this page just lays out sort of many of the different roles. And I'm going to go into more detail. But as you can see, almost everything you read in the newspaper, any kind of deal, any kind of transaction involves investment banking. And if you go to this page here and you look at the types of banks, you're all fairly familiar with banks. So on the left, you have a retail bank. You know, you put your savings into the bank and they lend it out maybe for a mortgage or for a car loan or whatever. And that's sort of the classic bank. That's the kind of bank everybody knows. In the UK, we call it a high street bank or a retail bank. Then you have a commercial bank. And the commercial banks are the bigger banks that you are familiar with. Again, they take deposits in. They also borrow money in the wholesale market. So in other words, they issue bonds. And then they lend the money out to small and medium enterprises as well as large businesses. And those are sort of the more integrated types of commercial banks. I wrote in brackets or in parentheses here, sometimes combined with investment banking. I was very interested to hear Dr. Brook mention that as you roll out investment banking here in Ethiopia, I gather you will be ring fencing the investment banking activities from the commercial banking activities. And that's a pretty interesting discussion we can have about that. But as you can see, commercial banks just do more sophisticated types of lending, leasing, trade finance. And again, I think most of you will be quite familiar with it. Then we come to investment banks, and investment banks, by and large, their core clientele are bigger companies. Many of them are listed companies or companies that are intending to list on the stock exchange. And we'll go through some of the services they provide, but as you can see, that M&A, mergers and acquisitions. So basically investment banks advise companies, and then they try to raise money for companies and sell businesses or sell divisions. They also do a fair amount of research. They also provide financing in all sorts of what I would call less conventional ways that maybe aren't quite as intuitive to all of you. And finally, you have private banking. So the people who manage rich people's money. HNW, that stands for high net worth. So think of family offices, think of oligarchs, think of billionaires managing their money. It's a different kind of clientele. Sometimes they are combined with investment banks. Sometimes they are not. But this page is kind of the landscape. And I think I want to dwell on this page a little bit because this page sort of sums up everything about investment banking. So if I just start on the upper left, M&A advisory. So if you take a step back, investment banks are all about linking two sides of people who have money and people who need money. People who have money want to invest that money, and the people who need money, they want money to buy a business, build a factory, build a road, or some other commercial endeavor. So M&A is basically investment bankers are advising companies on what to buy and what to sell, maybe even what to restructure. But it's buying and selling, mergers and acquisitions. It's a core competency of investment banking. If you've ever read books like Barbarians at the Gate or some of these other books, those are all the exciting bits. M&A is high stakes, it's intensive work, but but it's advisory work. They're giving advice on how to buy, how to sell. How much do we think this company is worth? How much should we sell it for? How much should we buy it for? What are the tactics we should use? Then comes ECM and DCM. And just so you know, my expertise, my core expertise was ECM. Now, what do these abbreviations stand for? ECM is equity capital markets. Equities are shares, stocks. So IPOs, listing on the stock exchange, doing raising money by selling your shares in the market. That's the classic equity capital markets activity. So whenever you see these big IPOs and these big listings on a stock exchange, that's ECM. DCM, debt capital markets, are when companies issue bonds in the market. So Toyota or Vodafone or any other big company will be issuing bonds. They'll issue short-term bonds, long-term bonds. You'll see high-yield bonds, investment-grade bonds, ratings around the bonds, everything around bonds. So ECM and DCM are both capital markets businesses. You're raising money not from going to a bank, but going to the capital markets. And you're either raising permanent capital in the form of equity, in the form of stocks, or you're raising debt in the form of bonds, so debt capital markets. Then you have sales and trading. So everything, when we raise money for companies, we then have to sell it to somebody, right? I mean, you want to raise your company, you want to raise capital in the equity or debt markets, but we have to then find buyers, people who will buy the stock, people who will buy the bonds. And when we sell it to, so we have to sell it to them, and then we have to trade it because they'll expect the banks to make a market in it. Okay. And so as a result, we have to do both sides of the what's called the Chinese wall. So you have people who are working with companies to raise the capital, that's ECM and DCM, and then people who are working with investors to buy, to sell it to them, and then to trade it for them. And there's a Chinese wall. There's a Chinese wall there between the private side and the public side. And this is incredibly important. So when you're working with companies, you have non-public information, confidential information. And then when you sell to investors, you're telling them what's in the public domain, what has been disclosed publicly, so they can make an informed choice whether to buy the shares or whether to buy the bonds. Research. Now, my column today in the FT is all about research, and you can read about it in detail there. But research, investment banks have an independent arm that researches company. They have equity research, so research on shares. They often have fixed income research, so research on bonds. They also often have macroeconomic research, and you often read about that in the newspaper when you read that Bank of America or Morgan Stanley's economist is projecting such and such growth for the year. It's a very important function. It's a very sensitive function, and some of the smartest people I know work in research. And last is investment management. Now, investment management can or cannot be part of investment banking. It really depends. But think of it this way. These are the people who buy the deals. They are investors, and sometimes they are affiliated with investment banks. Sometimes they aren't. So an example of one that's affiliated with an investment bank would be JP Morgan Asset Management or Goldman Sachs Asset Management. They're affiliated, but they're very much separate, and they operate very independently from all the rest of the investment bankers because their responsibility is to their end investors. Other investment banks, for example, investment management. So, for example, Bank of America, where I worked, had sold its asset management business many years ago. So it really doesn't have investment management. So those are the sort of the core competencies of investment banking. Now, within that, there's a lot of complications and a lot of variations, but basically, these are the core competences of investment banking. Now, investment banks come in different sizes. I'd say small, medium, and large. So, well, we use different terms because investment bankers are serial marketers. We're always coming up with jazzy new terms. See, we don't say small, medium, and large. Now, we say boutique, middle market, and bulge bracket. So the boutiques, and you can see them there, they tend to be M&A shops. They tend to focus very much on M&A and advisory. They don't have a capital markets business. They don't have a sales and research or trading platform. They're just giving advice. But they're very independent, and they often give very high-end advice. And you can see some of the great names in that area, including Foros, Evercore, Lazard, Moelis, Centerview, and Greenhill. Many of these were founded by investment bankers who had been working at the big firms and decided, you know, I want to work at a smaller place. I want my own place where I'm completely independent. And so some of the really best advisors work at those boutique investment banks. Then you have the middle market names, and these are people who have specializations in certain areas, certain core strengths, but maybe they aren't, you know, across the full waterfront, if you will. They're not looking for market share. They're looking to really focus on particular areas. So, for example, I'll just give one example, but Houlihan Lokey, they're a specialist in restructuring. They give advice on restructuring, especially for companies in financial distress. And they also provide M&A for small to mid-market companies. Cowen is a specialization in high-growth companies, especially in technology, just to give you an example. And then there are the bulge bracket banks, and you're probably pretty familiar with those names. Those are the big ones. The global colossuses, colossi? Not sure what the plural is. And Bank of America, Goldman Sachs, JP Morgan, Morgan Stanley, Citibank, UBS, Deutsche Bank. If I had done this presentation a few weeks ago, I would have had Credit Suisse on here, but not anymore. So, which goes to show that staying in the big leagues, if you want to stay in the Champions League or the Europa League, you know, you still have to work pretty hard. But these are the big banks. These are the ones you will have heard of. And many people, they start in the big banks, and as I said, they kind of then progress to more specializations. But across the full spectrum, the bulge bracket banks will provide the full spectrum of services with the possible exception of investment management. Okay, I'm mindful of time, and the one thing I don't want to do is bore my audience. So, look, why does investment banking matter? Why should you even care? I mean, is it just so that people can have nice suits and nice offices and hang out in cool places? No, I would argue that investment banking actually has a core social function, because what investment banking is about, it's about financial intermediation, about getting money from people who have it to people who need it, channeling savings into productive investments. That is what investment banking is all about. And so we use these terms buy side and sell side. You may hear them. So I'll explain to you what they are. The sell side, so corporates need money. You're a company, you need money. You go to an investment bank, that's the sell side. And the investment bank has two things. The investment bank knows the corporate, okay, the big companies, talks to them, pitches to them, does all sorts of presentations with far better graphics than I'm able to do as a private person to these days. And then they also have the contacts with investors who are on the buy side, who will buy it. Now, those investors could be pension funds, they can be insurance companies, they can just be hedge funds, long-only funds, mutual funds, sometimes private equity funds. The investment banks have an incredible network, and that's why the corporates are hiring the investment banks to get advice and then to tap into that network of contacts to raise money. So the sell side aren't selling the asset. The sell side are the investment banks, and the buy side are the buyers. And usually venture capital firms, private equity firms, mutual funds, hedge funds, you name it, pension funds, insurance companies, and so forth. And that is what financial intermediation is about, getting money from people who have it to people who need it. Okay, just to give you an idea of like how much money are we talking about here. These numbers are, to give you an idea, in 2022, which was a bad year for investment banking, it generated, $78 billion of revenues across the investment banks. And you can see here, these are figures that come from Refinitiv, and you can see the bulge brackets firms at the top. The American firms really dominate. And you can see where most of the money that's generated for investment banking comes from, about half from M&A. These figures are a little distorted because last year the capital markets weren't good. Normally, ECM is a bigger chunk of the pie, and normally DCM is a bigger chunk of the pie. But M&A and ECM are usually the two biggest ones. Syndicated lending, a lot of times banks do syndicated lending to finance, for example, M&A or a private equity buyout, and they do syndicated loans, and that's also part of the pie. But that gives you at least a snapshot. If I were to run the figures for 2023, it would look worse. So 2020 and 2021 were great years for investment banking. 2022 was a pretty bad year. 2023 is a pretty rough year. It goes up and down, and that's the way it is. It is a cyclical business. But that being said, even in a bad year, it's still an enormous amount of revenue because you're talking about global activity. So what value do investment bankers offer? I just try to sum it up here, and I've discussed a little bit, but it's expertise, it's experience. You need to know what you're talking about. Every time, when I was an investment banker, every time I wanted to go to pitch business, I would be competing against 5 or 10 banks. Corporates would usually make us do what we would call beauty pageants. And it's an expression, right? Because, aesthetically, if the aesthetics were the measurement, I would have lost every time. But they make us they ask for us, what are your credentials? Have you done a deal like this before? What's your experience? What do you think? And we have to talk about it. You need to show that you have relationships and networks. That's the most important. They really want to know that you can tap into a network of people who have money to raise money for them. Guidance and advice. You need to give advice. And not only do you need to give advice, you need to give independent advice, unbiased advice. And I actually talk about that in my column today in the FT. Innovative solutions and strategies. Sometimes you have to think laterally, you have to think smart, you have to look at different precedents, and sometimes you have to be creative, but still stay within applicable law and regulation. And last, you have to have the access to capital market intelligence. You need to know what's going on in the markets. You need to be plugged in. You need to know if people are struggling or if people are bullish or bearish in the markets. I was interviewed yesterday morning by the BBC about First Republic Bank and all the difficulties they're having right now. And, you need to know what's going on if you're going to give advice to somebody. You need to know what's going on outside even your own country. And people used to ask me, for example, when I was in Europe, what's going on in Asia? What's going on in America? What's going on in other countries? What's going on in emerging markets? Which leads me to my next slide. So this is very rough, but broadly speaking, we look at the world in sort of two ways. There are the developed markets, North America, Western Europe, and Japan, Australia, New Zealand. You can add a couple of others. And you have emerging markets, markets that have more growth, that are emerging. And those emerging markets are at very different stages themselves of development, and it masks an enormous amount of variety. But you can see sort of Asia, Latin America, Eastern Europe, and Africa would be in the emerging markets bucket. And as I said, within emerging markets, a lot of variation. Sometimes you'll hear this term frontier markets. And frontier markets are sort of the earlier stage emerging markets. And by and large, what I would say is that most of Africa would be regarded as a frontier market, along with probably Central Asia, parts of Latin America, and even some parts of Eastern Europe. Those are the frontier markets where you don't really have that much of a capital markets presence. Whereas if I can put it this way, more developed emerging markets would be something like Mexico, because it's so integrated into the US market, Turkey, because it's fairly integrated with Europe and it's fairly large. Russia used to be like that. Now, I guess Russia's a pariah market. I don't know. You can't really invest in Russia right now. China would also be one, or Brazil, which actually has a very developed capital market. So what I would say is, you're thinking about Ethiopia and you're thinking about Africa, it would probably be the more frontier market end of the spectrum, along with quite a lot of other countries which offer substantial amounts of growth opportunity. There's a lot that can be said, but why would somebody be interested in emerging markets? Why not just stay with what you're familiar with in Western Europe and North America? Well, Emerging markets, offer a tremendous percentage of the population and huge markets. You think of China, you think of India, you think of Ethiopia with 110, 120 million people. I mean, these are enormous markets that can be tapped for companies and for finance. You have faster potential economic growth. I think one real plus for Africa and especially for Ethiopia are the demographics. You look at a place like China, where the population is rapidly aging. I mean, or South Korea, that's a real issue for investors, and it's a mega trend that isn't going to change overnight, and they're going to have to confront in the years ahead. Whereas Africa and Ethiopia have much more favorable demographics, much younger populations, and that's actually something that's really exciting for capital providers throughout the world. And it provides greater investment appetite as well as diversification. You do not necessarily, investors want to have a diversified portfolio. They don't want to be just tied to whatever happens in the US or Western Europe, which tend to be fairly correlated. There are some downsides to emerging markets, and I think you're fairly familiar with them. Currency volatility, sometimes there's political instability. Emerging markets have risk for investors. Anytime you have high rewards, you have high risks, and there are stories of investors who've suffered substantial gains or losses, and have also had substantial gains in emerging markets. And I think the other issue I would just mention is this one: limited market liquidity and investment opportunities. Let's say I want to invest in Ethiopia. I'm from abroad. I want to invest in Ethiopia. It's not that straightforward. You're developing a stock market I've been reading about, and I'll be very interested to hear more about, but aren't really the kind of the deep debt capital markets that you have in North America. And by the way, this doesn't just apply to Ethiopia. It applies to countries all over Africa and most of Asia, to be honest, and most of Latin America. It's the same issues. Even if I like the country, let's say I want to invest in Uruguay, let's say I want to invest in Chile, where can I do that in a profitable way? Where can I find liquidity? And I think that's part of the challenge as you're developing your capital markets. You have to think about these second and third order issues. And by the way, liquidity is even a problem in Europe. Many of the European stock exchanges, the Western European stock exchanges, have actually relatively poor liquidity. And there's been a lot of discussion about that and a lot of frustration. Even stock markets as developed as London and Paris and Milan often have relatively disappointing liquidity for investors. So here's some of the key questions I'm going to wrap up in a minute. Just as you think about investment banking and the purpose of investment banking. Again, investment banking is something to look at and to pursue and to advance, not for its own sake. It has to be good for society. It has to help fundamentally challenge savings into productive investment. Okay, that's what it's for. That is its purpose. It does not exist so that people can, it does not exist for itself. How strong are the legal and financial institutions? I mean, this is something that Dr. Brook was talking about. Extremely important that the legal and institutional framework are robust in the country that we're dealing with. How consistent has corporate performance been? I mean, what can we expect from companies, from their earnings? Do the companies have strong accounting controls, auditing controls? These are issues that, for investors, they need to be comfortable around before they can invest. And the rules on foreign investment. This is obviously itself probably can have a whole separate conference about foreign investment rules. But who can invest? Can they have what size stake can they have in sectors that are deemed strategic? What are the rules for repatriating capital? And there are a lot of examples, and there's a lot of discussion around that. And what's most important is to have clarity more than anything else. You can even be slightly wrong, but just have clarity so that investors know the rules of the game and that they don't change on them. Often, clarity and certainty is more important than getting the right answer, which isn't something that people always realize. So, just my conclusion. I actually believe in investment banking. I actually think that it serves a social good. It gets sometimes bad press because bad things happen. People lose money. Sometimes people misbehave. But for countries that want to develop, for countries that want to raise capital, to make the investments that make their country stronger, better, their people better off. Investment banking absolutely has a critical role. But it's one thing to wish it, it's another thing to execute it and to implement it. And I'm going to be very interested to hear over the course of this conference and my discussions with many of you, your plans for building out investment banking. And I have experience in other parts of the world. This is my first time in Ethiopia, so I'm not an expert at all in Ethiopia, but I'll be really excited to hear from you and to share my thoughts and hear yours. So thank you all very much.
Laid out the investment banking landscape, and you ran through the small, mid-market and bulge bracket banks. You didn't reference Rothschild for some reason. I wondered if you could just elaborate a bit on why. And my important question is, you're getting to it at the end, but generally frontier markets really struggle to thrive as businesses and as investment destinations. Can you just sort of give us the benefit of your wisdom, top 3 mistakes that countries and regulators make when establishing a new market?
Thanks. I think my question is related to, you touched upon it now, and thank you for the great presentation, by the way. My question is on, first, on the Chinese wall between deposit-taking institutions and investment banking. I think there's a lot of interest whether commercial banks here in Ethiopia would be able to engage in subsidiaries, especially in the initial stages of building capital markets, and what would be the things to really look out for. Especially, we have the central bank chief economist here, and we want to really understand what kind of regulatory backstops we need, and if you could elaborate on the public enterprise and how they fit in this investment banking, because we have a lot of SOEs and potentially looking for investment in how we can create the regulatory system that makes sure that they get the funding in a fair way with the private sector. Thanks.
First of all, I should have included Rothschilds. That was a huge faux pas, but the lists were meant to be illustrative, not exhaustive. And I have a lot of friends at Rothschilds, and it is an outstanding boutique firm and one that I've worked with over the years. What are the top 3 mistakes? The top 3 mistakes, look, can I take a step back? I think you have to get policy right and business right before you can get finance right. And I think the biggest problems that frontier markets have is that they haven't gotten the policy right. You need to have liberalized markets and competitive markets. You need to float companies that are substantial enough that they have a liquidity. And that means to privatize them, in many cases, state-owned enterprises, partially privatize them. Because if you don't do that, then what ends up happening is that the markets end up being orphan markets. I also think, I didn't discuss this, but corporate governance is absolutely critical. And that means that shareholders have certain rights and protections. And that's very difficult because for companies that have been run by families or very powerful business leaders, it's very difficult to be able to give shareholders the kinds of rights and protections that they will need. And corporate governance is more sensitive in, I would say, a frontier market or emerging market context than in a developed market context. I think, though, that the biggest mistakes, though, that are made are around policy. I think that if you don't have a sort of good background policy, macroeconomic policy framework, it's very difficult to build out the financial sector because investors will be very reluctant to commit. The Chinese wall, we talk about Chinese wall, by the way, has nothing to do with China. That's between public and private. So people who are companies and investors. That's how I always think of Chinese walls. What you're referring to is, I would use the term ring fencing, that you want to ring fence your deposit-taking institutions from investment banking, because you don't want people who are putting their savings into a bank, you don't want that money to be used for trading purposes. Not that because trading's bad, But that's not the rule of the game. The rule of the game, especially if the central bank has to, in some ways, depending on the country, guarantee deposits. The central bank will guarantee certain types of banking activities. It will not guarantee investment banking trading. And it's a huge topic, and the UK has really been at the cutting edge of this. And I encourage all of you, Google UK ring fencing. It's a really big topic. And I think it's very interesting to hear Dr. Brook mention that straight up as one of the first topics to be addressed, because it was overlooked for many years, I think, to the detriment of those countries. The second question is about SOEs, state-owned enterprises, and privatizing them. Here's what I would say. If you look at Europe and the experience in the 1980s and 1990s of Europe, across Europe, the way they developed their stock markets, their stock markets were mostly backwaters, but they listed the national telecoms company, the state-owned bank, the national utility, the electrical grid, the gas grid. And these big state-owned companies, sometimes they listed minority stakes, sometimes they listed minority stakes and eventually sold out. In some cases, they still have a majority stake. But those are the companies, those are the biggest companies often in countries, especially in emerging markets, but not exclusively in emerging markets. And those are the ones that have the heft that will attract investors domestically and abroad. And I'll make one last comment. You need to have domestic investors as well. And I think that's often a challenge. Pension funds, insurance companies, family offices. And I think in a lot of frontier markets, what you actually find is that and I can't speak about Ethiopia, but that there is a lack of the buy side domestically. You can rely on foreign money, and foreign money is great, but you need to have domestic investors as well. And I mean, at the end of the day, this has to be, you need a domestic investor for two reasons. One, the money is stickier. And two, I think my experience is you need to have people within the country benefiting from that investment. And it can't just be for foreigners to come in. So that's what I would say about that subject. I'm mindful of time. I will be around anyway. We'll be doing the panel later, and I want to thank all of you.